All right. Good morning, everybody. So we made it through the PPI yesterday, relatively unscathed. Today is going to be the CPI. A lot of confusion over when our economic events are happening this week. And that's because on Monday, when the banking holiday was here, it pushed a lot of econ back a day. And so things that should happen on one day are now happening a day later. It's kind of getting a lot of confusion. CPI today, jobless claims. We got a lot of things going on over at the Bank of England. We have crude inventories, which is one of those that I was talking about. Normally, crude would be on Wednesday. It kind of feels like a Wednesday, but it's not Wednesday. So, just a little bit of oddities out there. Shy, HYG, and junk are still kind of coming up off of those lows a little bit. So, the whole Euro Asian currency contagion crisis is still floating around. Looks like Bank of Japan is actually starting to finally defend a little bit after it got to 146.8. It's a long ways away from 145, that's for sure. There has been a little bit of contagion between the UK and the US, mostly on junk and, like high yield and things like that. Just continue to watch that 10-year. I was coming in looking at the December probabilities for rate hikes. And like we've done before, if you game it out and you think about where we are right now, we're at 3. If we get a 75 basis point rate hike on November, then we wouldn't be at 3 anymore. We would be at 375. And if we're going to go from 375 to 425, then that would only be a 50 basis point rate hike for December. But they're turning around now, and they're starting to price in another 25%. So instead of getting 50 basis points, they're pricing in 75 basis points. And this number is going up, right? And that is that's bad for equities, right? Kind of puts pressure on the S&P and the NASDAQ because they got to price this in. We can see that they're pricing it in because we can look at, well, where was 450 and 475? That's the number you want to look for. Where was it, say, a week ago? Well, a week ago, there was a 7% chance. Now there's a 32% chance, right? So they priced in 25% over the last week. So a week ago, it was like down here. Now it's sitting way up here. The more that this goes up, the more that this is going to have to go down, right? Because when you add all of these together, it makes 100. So, or, kind of close to 100. And this is for December. So then, we want to jump over to February and say, all right, well, if we're at 475 at that point, right, kind of back up here, we would be at 450. From that, come over into this, where would we go from there? 25 basis points. And that's what we got, right? Now, continue to watch this. I would focus on December right now. Since that's the one that's, like I've said before, November 2 is basically set in stone at this point. I mean, it could change, but if it does change, I think what the change would be is that we completely take this one off. This starts to go down and a new number starts to show up. And that would be the expectation that we get a 100 basis point rate hike. That's not on the table now. As you can see, there's not even a column there, right? Nobody is talking about it, thinking about it, suggesting it, nothing like that. But if there was going to be a change for the November 2 at this point, that's the change that I would anticipate. The dollar continues to be a part of the discussion of what's going on. For the bigger picture on the dollar, we're still looking at like 120, 125, right? Things are certainly not done there. Trading the dollar in things like the UUP, I hate that thing. Every time I trade it, I get assigned with options. So you can trade the dollar futures. They're just a smaller version. Use the smalls exchange, and you can just straight up trade the dollar, right? These things, there's no PDT. There's no change in overnight buying power. So the buying power you need to trade during the day or to hold them overnight is exactly the same. They expire every month, so you can just continue to roll them or close them. Some of these smalls have options, some of them don't, right? But these smalls are a completely different kind of futures product. And you can get exposure to all kinds of great things that we normally wouldn't trade just because of how big the buying power reduction and the risk is, right? So with these, you could trade the dollar, precious metals, the 2-year bonds, 10-year, 30-year. The risk right now, if you were to be a betting person and believe that this contagion is going to spread, would be a threat that the 10-year takes off like a freaking rocket ship, right? And then the Fed has to step in, and they're going to activate some kind of tool. And well, you could go long treasury, the 10-year treasury here, way cheaper than you could say trying to get into different FX markets, or depending on who your futures broker is, by trying to actually go to the futures. So these smalls futures, they don't use fractional notional value, which is nice. You don't have to worry about 1/32 and fractional values, which is cool. And you can also trade, say, like the 210 curve, if you think the curve is going to steepen, or if you think it's going to flatten out. Right now we're inverted. So say you think that's going to dissipate and we're going to come back up. Well, we will eventually. You can trade those. So if you're not trading in the smalls, consider it. Right? You get exposure to markets that you don't normally have exposure to. CPI, and then we've got additional auctions all the way around the curve today, from the front end IRX with 3-month, and then you got your 5-year all the way out, 4-week, 30-year bonds. So a pretty broad auction. And one of the oddities that we've been seeing is nobody's standing up to buy any of it, right? That's been a little uncomfortable, I guess, is a good way to say it. But the auctions today are at 11, 11:30, and then 1 o'clock. And that always screws with 0 days. Although I would have to argue that today is not necessarily the day to be running some 0 days, because we've got a lot of stuff on the books today to deal with. The main thing is going to be the CPI, right? And the expectation is, even though we got through PPI yesterday relatively balanced, I don't think that's what's going to happen today with CPI. Now, we always want to give everything that could happen its chance, right? We want to talk about the fact that we could go up, we could go down, but we could also just hold the line, right? I'm not making an argument that we couldn't just hold the line, because we can. So CPI today may come in and it could be so off-putting and confusing that they just call timeout and wait for the nerds to sort it out. I don't think that's going to be the case, but we never want to say things like, well, it can't do this or it can't do that. Price can do whatever the hell it wants. Volume is light today, and that kind of makes sense, right? Because everybody's waiting on the numbers, and it's not an exaggeratedly light volume. It's just a little light. See, we're getting a little bit of excitement here. This guy's throwing firebombs. So today you want to be on the lookout for where we're going to go from here, right? And it's just like we've been discussing. There's no amount of technical analysis that's going to prepare you for the absolute whiplash that this market is going to likely go through when we get CPI today. If we were to go back to the last CPI, you kind of get a feel for what our expectations should be today. And the last one was September 13th, which for me, I find that date pretty easy to remember. Why am I missing it? That's what I get for watching this up here. If you don't use Thinkorswim much, there is your dates up here. And I was watching that instead of just looking for this big spot right there. This was the last CPI. Now, by the time everything was done, it took a little over a week. The market dropped over 600 points. In the first 5 minutes, it dropped over 150 points. Right, that was 119 right there, and then 150 right before the open, 144 points. That's not trend, right? I had someone mention trend the other day. Was I expecting a trend down? That's not a trend, right? That's like a liquidation break. Even this could be argued to not be a trend, right? It's like one-time framing, consistent, persistent, nonstop price action with almost no profit taking. Very, very slight, minor profit taking. This is pure algo, very, very clean, very controlled selling, very beautiful. It's hard to spot that in when it's happening and be able to call it. But looking back, it should be purely obvious. So this is our expectation, one direction or another, right? I'm not saying that it has to go down today. Be perfectly frank, it doesn't have to do anything, right? We're talking about it going down because we're expecting that the CPI is going to be a little hot. But every time everybody sounds convinced and they think they know what's going on, that's when I tend to get a little nervous because we don't know the numbers. We've got estimates, we've got projections. They do a consensus, which is just silly. They'll ask, quote, sophisticated investors what they think it's going to be. And then they tally up everybody that they asked and they say, oh, look, more people think it's going to be high or more people think it's going to be low. It's just a survey of supposedly sophisticated individuals. Still have the yellow lines from yesterday. These are the measurements for how far we could move today. We've got an ADR of 2.5 from the Globex open. If we measure to the upside, 4.5. 37.63. Do the same thing going in the other direction. 34.25, basically. There's our range for chaos. Now it can go more than this. This would be our base case argument if we don't hit lock limits, right? Because that would be beyond 7. This is a 4.5. I would be expecting 4 if things got bad. 4% up, 4% down, and not more than that. Getting beyond 4 and into that next level of bad kind of is on a whole other level. And I don't expect it to do that. I really don't expect it to make the 4%, to be honest, but things can cascade and really start to pick up speed, especially when it's a downside move. Now, in the current market, and I was mentioning this the other day, people are just finally starting to actually get net short. And so if we do make a hard, sudden break to the upside, the squeeze that would be present on those short traders is going to be epic. And that can fuel the move even more, right? So the threat right now is a move to the upside since everybody is so positioned for a downside move. And you can see that in the tail, the long tail risk, right? So it was a little bit of a surprise to see the dollar down like this, back underneath that 3-day moving average. Going to look to see if it finds support around that 112.5. It is still digesting or consolidating, use whatever word you like. It's not expected to break below the 110. So, this little consolidation zone, it's made some pretty epic moves lately. And with everything that's going on, it makes sense that it's going to have some kind of a pause for a little bit. But the consensus seems to be that we're not done with the dollar and that yearly highs could exceed 125 by the end of the year. I think that's a bit much. 120 would be extreme, right? It would be significant globally just to get to 120. I mean, we're talking about breaking things at that point. So 125 seems a bit much, but getting up into 120s does not, right? Even the high teens, 18, 19. The VIX continues to improve now, and I attribute a lot of that to Barclays getting sued for manipulation. They weren't the only ones. They were just the biggest name in the lawsuit. They got caught with their fingers in the cookie jar. And now that they don't seem to be heavily manipulating the VIX, it's starting to respond a little bit more. There is backwardation right now. The 1-month VIX, which is just VIX, is at 33.38. while the 3-month VIX, a farther outdated VIX product, is at a lower value, right? So we're sloping downwards there, and sloping downwards is backwardation. Then if you go from the 3-month to the 6-month, we're going up again a little bit, right? So it's not a full on curve, say like that. It's more of a curve down and then it's coming back up. They actually have names for these, like volatility smirk or volatility smile. And it sounds funny when you hear it, but if you actually go and search it and start reading and pick up on it, it makes sense, right? It's just weird to see that kind of language in financial statements and articles and things like that. Skew is still soft, and the volatility within the volatility index, what I call the implied volatility of VIX, is still elevated. We're still riding above that 3-day moving average. So right now that Japan is actually defending, you want to keep your eye on that in relation to the dollar. And you definitely want to watch the 10-year. And don't forget, we have the 30-year auction today, and IRX, which is like the front end of the curve. This is getting into levels where we start talking about things getting broken too, right? We're starting to get into kind of aw damn levels. There's the 07-08 housing crisis. There's the dot-com bubble. And the 1995-96 event. I don't know if they have a name for that event yet or not, but if you look at rate hike cycles, which doesn't necessarily have anything to do with this chart, but on average, rate hike cycles generally get to around 4, 4.25, 4.5, maybe at the most, right? In December, we're expected to be there, which is one reason everybody keeps talking about the Fed should pivot, or maybe it could pivot, or it's possible that we could pivot, blah, blah. That pivot language comes in a lot when we get near that 4.5. Now, the Fed's made it clear this isn't where they're going to stop, but in a normal rate cycle, that's generally where we do stop, right? So they're talking about taking things beyond the norm and getting into even more levels of things getting broke, right? Getting into that kind of an epic situation. Now, before I've got notes. If I take these off, I think I've got notes. Nope. I don't have my notes. That's too bad. So there was a great article that had all of the rate cycle dates that would go with this chart. And maybe I got a picture of it. But either way, the rate cycles tend to tap out at about 4.5. And there was this really great chart that was going around that showed that right now the Fed is trapped. They're kind of stuck, and they've most definitely gone too far, right? They overshot the landing. So we'll see, right? The main thing for today is with the auctions that we've got on the table, we're talking about everything from a 3-month to a 5-year. Actually, it's 3, 6. Let's reverse that again. 4-week, 3-month, 6-month, 5-year, 30-year. Right? So we're talking about things in the really, really front end of the curve, and then 5 years out, and then 30 years out. And the front end of the curve, the IRX, this is short term, so like a 3-month. And it's been on an absolute tear, right? Since the first of the year. So when we talk about watching the TNX, the 10-year yields, kind of keep your eye on, say, critical levels. 4217 is not even close to being one of those levels. I think we got to get into a different chart here. We are at the 1236 in the Fibonacci. For those that's gone through with me on Fib, you know that this is the level, this is like the target, right? So once we get there and we don't continue through it, we get the validation to be able to move the Fib to this new spot, right? So we wouldn't be using this left side anymore. We would actually have the Fib brought all the way up to our current level, not using those wicks. So either there or there. I'd be okay with either one of those. And that lines us out for our new projection. The 1236 would be 4706. That's 4.76%. Ah, getting into some pretty radical territory. Okay, you're looking at the 10-day, 30-minute volume profile. Point of control is over our head. The shallow area starts right around 36.5. We start getting into some soft, shallow area, and it doesn't really pick back up until we get 37.8, which is an area we've mentioned quite a number of times, right? So 37.35, 37.50, there's a pivot here, but there's no real resistance there. So if we do start making that move to the upside today, you could look for like a first touch blush, maybe a tag and drop, but I wouldn't expect that to be a significant level of resistance. We don't really see any of that until we get right up into the 3,800. We have no points of control to bring forward. The value area and high and low, there's no reason to bring any of that forward. So that's the things to watch for today. Keep your eye on the VIX and the backwardation. Continue to watch US, Japan, see if they're going to continue to defend. We want to see it get back below the 3-period daily moving average, and keep your eye on the dollar. It's not a whole lot to keep track of. It's not like you got to sit and stare at them all day anyways. Just kind of reference them, glance at them once in a while through the day, make sure everything is fine. Otherwise, this should be the event of the year. It is very likely going to be the most significant event that we've had up to this point. I don't want to say that it's going to be the biggest one all year because, well, I mean, the year is a long ways from being done. But this should very likely set the tone, say, all the way up into Thanksgiving. And of course, there's always going to be something else on the table. And we could see things start to break tonight, which would be Friday in the UK. Friday is when the assistance is supposed to end. And if that ends Friday, as we get up Friday morning, it will already be very likely already be starting to spread if there's any kind of contagion. Worst case scenario, it would be what we start to see Sunday night and into Monday morning. So even when we get through CPI today, we still have that Euro-Asian currency contango crisis to deal with. Be careful, everybody. Be safe. I will see you all tomorrow.